Hey everyone, welcome to my channel. I'm Doris. I'm here to share with you about my stock account and today's market updates. And today let's take a look at the US capital market forecast for the December of this year. US stocks have recently posted their longest winning streak in 4 years, with the S&P 500 and Nasdaq recording their highest close since early 2022. The market digested the latest employment data, and while expectations of a rate cut were hit by non-farm payrolls, they also sparked investors' optimism about a soft landing. Markets face the final test this week, while their optimism is about path of interest rate will be endorsed by the Fed. The money flows also showed that investors seem to be preparing for their potential volatility. As the Fed has entered a period of silence, economic data can only be used for clues for monetary policy. The Fed's latest job opening unexpectedly fell to a 2.5-year low, and initial jobless claims rebounded. The non-farm payrolls data showed that labor market remains resilient. The U.S. added 199,000 jobs last month, and the unemployment rates fell to a 2-year low of 3.7% as more job seekers enter the market. Meanwhile, wage growth unexpectedly increased, rising 0.4% month-to-month. Senior economist at Oxford Economics told China Business News that the return of auto workers has distorted in recent months, and there are many signs that the pace of job growth has slowed. That is encouraging for the Fed, as they may have rolled out further rate hikes. Moderate employment competition and slowing demand in the cooling economy will also help to further reduce the price pressure in the future. The U of Michigan December consumer survey also showed this, particularly that the U.S. consumer confidence for next year's inflation rate has fallen. The outside world is weighing up on the Fed's next move. The non-farm data weighed on the prospect of a rate cut in March, with the market analysts putting the Fed in wait-and-see mode, and a cut could be too early in a strong labor market. Treasury yields stabilized late this day and posted their biggest one-day gains in nearly a month, with a 2-year note, which is closely linked to interest rate expectations, boomed out to 4.24%, and the benchmark 10-year note also back above the 4.7% mark. The probability of a rate cut fell to 45.6% in March, down nearly 20% points from the previous day, according to the FedWatch tool. But concern about tight policy efforts could still hurt the economy, and the interest rates it'll be possible for interest rates to stay higher for longer. But in the context of winning the inflation war, this must now be careful not to tighten too much. The new U.S. stock rally that began in the late October continued, with the 3 major indexes heading for 6 straight week gains, and the S&P 500 recording its longest winning streak in nearly 4 years. By the end of last week, the S&P 500 was less than 5% from its all-time high, while Nasdaq, which plunged into a bear market in the second half of the year, was less than 10% away from the new high. The COBE Panics Index, which is a key measure of volatility, dipped again to its lowest in the late trading days of the year, driven by investors' risk appetite and optimism. This is all I have for today. Thank you for listening. Don't forget to subscribe and see you next episode.